Capital is nothing but the investment that you are putting into your business. So the returns are very late. So you have to expect a return at a stipulated period of time. The cost of debt may raise at a par, at premium and at discount. So this cost of debt is what? It is the rate of return expected by the lender. Cost of capital is the minimum required cost of return expected by its investors. Hello everyone, a very good morning to you all my dear students, and I welcome you all for today's session, that is your session 1 on your chapter 1 called Cost of Capital. So I am your Divya ma'am lecturing Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. The topic for today's discussion, concepts and formulas. So in the previous class we have discussed about the syllabus and the weightage of each unit for your examination. In today's class we'll be discussing about your first module, that is your cost of capital. Moving forward, so let us understand first what is cost of capital. Capital is nothing but an investment that you are putting into your business. So what is capital? Capital is nothing but the investment that you are putting into your business. So the returns are very late. So you have to expect the return at a stipulated period of time. So what is the cost that is associated with each capital? So when you are investing in a business, let's say for example 50 lakh is the investment that is required in order to run a business, in order to invest in certain project, but you have only how many rupees? Only 30 lakh rupees is the investment you have. Another 20 lakh, what you'll do? You will take up the loan. And what is that loan? Simply they'll give it? No, they take up the interest. For interest purpose, you will take up the 20 lakh loan. So what is the 20 lakh? 20 lakh is a debt for you people. And what is the cost for raising that loan? Interest is the cost, the additional cost that is there for you people for taking up the loan. So what is the cost associated with each capital? So what are the different sources of capital? So we have equity capital, preference capital, debenture and retained earnings. So all these are the different sources of capital. So what is equity shares? So equity shares is nothing but the shares that you issue from the public. So what is equity? What is equity shareholder? Who are the equity shareholders? Equity shareholders are the real owners of the company. What is preference shares? Preference shares have a preferential right over their dividend. And what is the cost that is associated with the preference share? It is nothing but whatever, irrespective of the return, they have to be given the fixed dividend. So that is the cost that is associated with preference share. When it comes to debenture, debenture is a long-term debt. It is a long-term source of finance. So in long-term source of finance, you have to pay the interest. So that is the cost that is associated with the debenture. When it comes to equity shareholders, why they are called as real owners of the company? So after paying the interest, after paying the dividend and after paying the tax, whatever the leftover return is there, so that return will be given to equity shareholders. And what is this retained earnings? Once the return comes to the business, the company decides whether to keep it as retained earnings or to distribute as a dividend. So why they keep it as a retained earnings? Because this act as a internal source of finance for the next year. So that is the retained earnings. So what is the cost that is associated with retained earnings? It is the opportunity cost. So if they have given to the shareholders, shareholders would have returned to to the company and they would have reinvested their shares, but we are retaining the earnings. So what is the minimum rate that they have to get it, so that the shareholders return as they get. Moving forward, so what is capital? Cost of capital is nothing but it is the minimum required cost of return. So what is cost of capital? For raising the various source of finance, what is the cost that is associated with each sources? So that we will compute in cost of capital. So cost of capital is the minimum required cost of return expected by its investors. Moving forward, so how do you compute the cost of capital? The first thing is you have to calculate the specific source of finance. What are the different specific source of finance we had? We have equity, we have preference, debentures and retained earnings. Symbolically it is represented as cost of equity, K, subscript with E, cost of preference, K subscript with P, and this is cost of debenture, this is cost of retained earnings. So the overall cost of capital is called as what? KO. So this is the symbolical representation that is there. So first thing what we have to do is calculate the specific source of finance. What are the different source of finance? We have equity, so we have to calculate what is the cost that is associated with equity share capital, and what is the cost that is associated. What is the cost? We have to calculate first. First thing is calculation of specific source of finance. The second is weighted average cost of capital. The overall cost has to be calculated. So what is this cost of debt? Cost of debt, as I have told you, it is a long-term debt that has been raised by the company, that has been taken by the company. So cost of debt may raise at a par, at a premium and at a discount. So how the company will raise the funds from the public? By issuing of shares. So how they issue the shares? If they issue at a face value, then it is called as par. If they issue more than the face value, it is called as premium. If the face value is 100 rupees, if they are issuing at 90 rupees, 10% is the discount. More than the face value, it is premium. Less than the face value, it is discount. And whatever the face value it is there, if they issue the shares at that, it is called as what? Par. Let's assume 100 is the face value. If they issue it on 100 rupees, then this issue is called as par. Next, if the face value is 100, if they issue at 110, then it is called as what? Premium. If it is 100 rupees, then they are issuing at 90 rupees, then it is called as what? Discount. So the cost of debt may raise at a par, at premium and at discount. So this cost of debt is what? It is a rate of return expected by the lender. So we have cost of irredeemable debt and cost of redeemable debt. So what is this redeemable and what is irredeemable? Redeemable is nothing but the company has to repay the money within the stipulated time period. Let's say they have raised 5,000 debenture of 10% interest for 5 years. So they have to what? They have to return within the 5 years. So stipulated time period, determined time period is there. So 5 years is the time period. So in that 5 years period, they have to repay the debenture money. That is called as what? Redeemable. What is irredeemable? Irredeemable means the company need not pay during the lifetime of the firm, but once the company closed, once the company is winded, then the company has to repay the money. That is called as irredeemable debt. So redeemable, irredeemable, redeemable debenture and irredeemable debenture. So in your examination, mostly they will be asking you on redeemable debenture problem. So this is the cost. What is the cost that is associated with the debt? It is nothing but the interest, whatever the interest they have to pay. Moving forward, the formula for cost of irredeemable debt. We have before tax and after tax. So before tax formula, KD is equal to interest divided by net proceeds. So K subscript with D, it is nothing but your cost of debt, and I stands for the interest, NP is the net proceeds. Again, after tax we have the cost of debt is equal to interest divided by net proceeds, 1 minus tax, 1 minus tax. So this is the formula after tax. So this is the formula for cost of irredeemable debt. And next, the formula for cost of redeemable debt before tax and after tax. Cost of debt is equal to interest plus maturity value minus net proceeds divided by number of years, whole divided by maturity value plus net proceeds divided by 2. So this is the formula before tax. And what is the formula after tax? Cost of debt is equal to 1 minus tax plus maturity value, my interest plus maturity value minus net proceeds divided by number of years, whole divided by maturity value plus net proceeds divided by 2. So this is the formula for redeemable debt. Next, moving forward, we have preference share. As I have told you, preference share is one of the main component of the capital structure, a component of a capital structure which carries fixed rate of what? Dividend. So irrespective of the return, there will be a fixed dividend that has been given to the preference shareholders. So as per the Income Tax Act, the dividend payable on preference shares are not allowed as an expenses. So hence there is no adjustment required for the factor, but there is a preference dividend that has to be paid for the preference shareholders. And the formula for irredeemable preference share is K subscript with P. Cost of preference share is equal to dividend divided by net proceeds. So what is this? DP stands for preference dividend. What is NP stands for? Net proceeds. So this is the formula for cost of irredeemable preference share. So how do you understand in your problem whether it is irredeemable problem or redeemable problem? Wherever redeemable problem is given, number of years will be given. So if this number of years is given, then you'll understand that it is a redeemable problem, and you will have to put the formula of redeemable formula. So in redeemable formulas, number of years will be given. And how do you bifurcate whether it is after tax or before tax? Tax percentage will be given. Corporate tax is 40%, corporate tax is 30%. If that percentage of tax is given, then you have to put after tax formula. Moving forward, we have cost of redeemable preference share. So this is what redeemable preference share formula. So KP, cost of preference share, is equal to dividend is equal to maturity value minus net proceeds divided by N, whole divided by N maturity value plus net proceeds divided by 2. So this is the formula for redeemable preference share. Moving forward, we have cost of equity share capital. As I have already discussed you what is equity share. Cost of equity share may be defined as the minimum rate of return that a firm must earn on the equity, financed part and investment in order to unchange the market price of the share. So once the return you get, you have to distribute to the dividend, preferential dividend holders, and then you have to give it to the interest. Then the company has to pay for the tax, and later whatever the leftover item is there, leftover money is there, that has to be paid to the equity capital, equity shareholders, and that is the cost associated. That is the minimum rate of return the equity shareholders has to earn. In other words, cost of equity is the rate of return which equates the present value of expected dividend with the market price of the share. Moving forward, methods or approaches for the calculation of equity capital. Dividend yield return method. We have dividend yield plus growth method. We have earning yield method and realized yield method. The formulas for calculating cost of equity is equal to, first formula, cost of equity is equal to EPS divided by net proceeds. So what does this EPS stands for? Earning per share. And what is the abbreviation of NP? It is net proceeds. The another formula is equal to EPS divided by market price. In the question, if they ask you the market price, then this is the formula you have to apply. And next we have another formula. K subscript with E is equal to earnings or dividend divided by net proceeds plus growth. So if growth is asked, growth is given in the question, you have to apply this formula. And next we have is cost of equity is equal to earnings or dividend divided by market price plus growth. So these are the formula to calculate the cost of equity. Moving further, methods of equity calculation we have discussed. Now let us discuss about retained earnings. So what is retained earnings? As I have told you, when you get the return, either the firm will distribute them as a dividend or they will retain them back because it acts as a internal source of finance for the next year investment. So what is the retained earning cost? It should be the cost of equity is equal to cost of retained earnings. So what is the cost that is associated with retained earnings? It is nothing but the opportunity cost, because you people have retained the earnings within yourself. If it is given to the shareholders, they would have come and invest in your company back, but here you are foregoing them. So instead you are retaining them. So whatever the investment that you put, the return should be equal to the shareholders return. So that is the cost that is associated with your retained earnings. So cost of equity is equal to cost of retained earnings. That is the formula of your cost of retained earnings. Next we have weighted average cost of capital. What is this WACC stands for? Weighted average cost of capital. It's symbolically represented as KO, or it is also called as overall cost of capital. So what is this overall cost of capital? Specifically, you people have calculated the various sources cost, but you don't know what is the overall cost, because based on overall cost only the firm will take up the decision. So in order to know the overall cost, we have WACC. Okay, in that WACC you will get to know what is the overall cost of capital. For raising the different sources of funds, what is the cost that is associated? What is the overall cost? Okay, so KE, KP, KD, KR is equal to KO. So the overall weight, the overall cost is calculated by using the method called WACC. So it refers to the weighted average cost of different sources of finance. It may be defined as the rate of return must be earned by the firm in order to satisfy the requirement of different types of investors. WACC can be calculated by summarizing all the cost. So this is the formula for WACC. Moving further, this is the format for WACC. So this will come for your 15 marks. The problems on WACC will come for 15 marks. So it is a 15 mark problem. So it's a very important chapter, my dear students. So if you study first unit, that is your cost of capital, you will be able to score 30 marks in first unit itself. So it's very important. Learn how to solve the problem very carefully. So what is the format? Sources of finance, different sources of finance, equity share, preference share, retained earnings, debenture or debt, and amount of that, weight of that, and specific cost that we have calculated by using the formulas, and what is the weighted cost. So how do you calculate weighted cost? Weight into your specific cost, you will get your weighted cost. So this is the format of your WACC. So I'll move out of the screen. Kindly take up the screenshot of all the formulas and the format. This is the format for your WAC. Retained earnings, formula for your irredeemable debt. This is the formula for irredeemable debt before tax and after tax. Formula for redeemable debt before tax and after tax. Irredeemable preference share formula. And we have cost of redeemable preference share formula, cost of equity formula, and cost of retained earnings formula, and this is the WAC formula altogether we have. That's it for today. Hope the class was very interesting, and whatever I have taught you people regarding the formulas, regarding the different types of cost, you people have learned. So thank you so much once again for joining me. Smile is the biggest jewel you can wear. Keep smiling, people. Thank you.